The Economic Club of New York is proud to stand as the nation's leading nonpartisan platform for discussions on socioeconomic and political matters. For more than a century, the Economic Club has been a platform for thought leadership and dialogue. Today, we're privileged to continue that tradition with our distinguished guest and club member and my friend, Alberto Musalem. Alberto is the president and CEO of the Federal Reserve Bank of St. Louis, one of the 12 regional reserve banks in the Federal Reserve System. He served in this role since April of 2023, participating in the Federal Open Market Committee and overseeing the 8th Federal Reserve District activities, including economic research, financial supervision, and regional payments. An economist with public and private sector experience, Alberto was previously CEO and co-CIO of Events Asset Management and an executive vice president at the New York Fed, where he had key policy and international affairs groups under him. Earlier in his career, he was a managing director and global head of research at Tudor Investment Corp. He has served on the board of the Federal Home Loan Mortgage Corp. And was chair of the School of the World, a nonprofit focused on education and poverty alleviation. He's also taught finance at Georgetown and international financial markets at Johns Hopkins University. Alberto holds a PhD in economics from the University of Pennsylvania and a master's and bachelor's degree from the London School of Economics. Today's program will start with opening remarks from Alberto, followed by a fireside chat. We're honored to have club member and former vice chair, Abby Joseph Cohen, as our moderator. Abby is a professor of business in the economics division at Columbia Business School and a retired partner at Goldman Sachs. Time permitting, we will take questions from the audience. A reminder for everyone that this discussion is on the record. We have a lot of media, both online and in the back of the room. We will, though, end promptly at 1 p.m. So without further ado, please join me in welcoming to the podium President Alberto Musalem.
Well, Barbara, thanks for that kind introduction, and good afternoon, everyone. It's a real pleasure to return to the Economic Club of New York and to reconnect with so many friends and former colleagues. I'm also looking forward to an engaging discussion with Abby Joseph Cohen. I'll first offer some remarks about how I perceive the economic and financial conditions, the outlook, and some plausible alternative scenarios with monetary policy implications. Let me stress that these are my personal views and not necessarily those of the FOMC or my colleagues on the FOMC. I know the importance of getting to the point in New York, so let me do that. In my view, the economy and monetary policy are in a good place. I believe patience will help us as we seek maximum employment and price stability for the American people. Doing that work must be our focus all the time. Last month, the FOMC voted to leave its target range for the federal funds rate unchanged at 4.25% to 4.5%. I supported that decision because economic growth is robust, the labor market is solid, financial conditions are supportive of growth, and inflation remains above target. The U.S. economy is strong, with both the level and growth rate of GDP at or above long-run potential. The labor market conditions remain solid, with the unemployment rate at or below estimates of its natural rate. Inflation has fallen considerably from its peak, and there has been little or no cost in terms of foregone employment or economic activity. However, inflation is still above 2%, and some measures of inflation expectations have recently risen. After 100 basis points of interest rate cuts in the fall, I judge that monetary policy is modestly restrictive and meaningfully less restrictive than it was 6 months ago. I believe it's appropriate to monitor economic conditions and the outlook before making any further adjustments to the stance of policy. Monetary policy is well positioned to address risk to both sides of the FOMC's dual mandate. If the economy remains strong and inflation remains above target, then I believe that modestly restrictive policy will remain appropriate until there's confidence that inflation is converging to the FOMC's 2% target. If the labor market conditions were to deteriorate while inflation expectations remain anchored at a level consistent with 2% inflation, I believe policy could be eased further, and I'll say more about this later. The U.S. economy entered 2025 on a very solid footing with healthy forward momentum. Consumers continued to power growth. Personal consumption expenditure grew at a robust 4.2% rate in the fourth quarter, the highest of any quarter in 2024, while real final sales to domestic purchasers grew at a healthy 3.1% rate. The prospects for continued solid growth look good. Balance sheets of firms and households are generally in good shape. Financial conditions are supportive of economic activity, especially for borrowers who directly can access capital markets for funding. Surveys indicate that business confidence has risen in the last 3 months and that planned capital expenditures have increased. However, measures of economic policy uncertainty are higher than average, and this could weigh on the spending plans of businesses and consumers. Recent surveys suggest consumers are becoming somewhat less confident, and January retail sales suggest they might be more cautious. But December sales were strong, and I'm not overly concerned by a single month of data. Labor market conditions remain solid, and I see the risk to employment as roughly balanced. After softening through the first 3 quarters of 2024, the labor market has stabilized and has recently shown some signs of strengthening. Payroll growth averaged 237,000 over the past 3 months, exceeding the break-even pace, and the unemployment rate ticked down to 4%. Job openings and quits rates have declined, but layoffs have remained low. A recent National Federation of Independent Business survey found a sizable net percentage of small businesses are expecting to add jobs in the coming months. Recent surveys conducted by several Federal Reserve banks also show increases in the percentage of firms planning to add jobs in the months ahead. While growth in average hourly earnings and other measures of employment compensation have remained firm, the labor market does not currently appear to be a significant source of inflationary pressures because productivity has also risen. I will continue to monitor the balance between compensation growth, productivity growth, and inflation going forward. Inflation has retreated substantially from its peak in mid-2022, but remains above the FOMC's 2% target. The January CPI report showed large monthly increases in goods, services, and shelter prices, and for core as well as for headline inflation. Based on the CPI and PPI reports, the core and headline PC price indices are estimated to have increased by around 0.3% in January. If so, that would imply a core inflation rate of 2.6% and a headline rate of 2.4% on a 12-month basis. Residual seasonality has been suggested as a contributing factor, at least for CPI. But taken at face value, the reports show that more work is required to achieve price stability. Looking ahead, I expect inflation will continue to converge to the FOMC's 2% target, and the labor market will remain near full employment. This baseline scenario requires that monetary policy remains modestly restrictive until inflation convergence is assured, at which point the policy rate can be gradually reduced towards the neutral level as convergence progresses. Critically, this scenario requires that inflation expectations stay well anchored. Various changes in trade, immigration, regulatory, fiscal, and energy policies, or other changes in the economic environment could materially affect the path of the economy. My baseline scenario assumes that the net effect on inflation and employment of all such policy changes will be small in the near to medium term. Around this baseline scenario, the risks of inflation stalling above 2% or moving higher seem skewed to the upside. A January survey by the National Association of Business Economics found a higher percentage of firms expecting increased material costs and a higher percentage that have plans to raise their prices in coming months. Federal Reserve Bank surveys also show evidence that firms expect to raise prices over the next 6 to 12 months. Market and some survey measures indicate that near-term expectations of inflation have risen notably over the past 3 months, while the University of Michigan survey shows some firming of long-term consumer inflation expectations. I'll be monitoring these developments closely for signs that short-term expectations of higher inflation could be feeding into medium to long-term inflation expectations. An alternative and plausible scenario in which inflation ceases to converge or rises at the same time the labor market weakens must also be considered. This scenario could arise for a variety of reasons. These days, higher tariffs and immigration policies are often discussed and thought likely to increase prices, cool aggregate demand, and possibly soften employment. From the standpoint of monetary policy, it could be appropriate to ignore or look through an increase in the price level if the impact on inflation is expected to be brief and limited. However, a different monetary policy response could be appropriate if higher inflation is sustained or long-term inflation expectations rise. In that scenario, a more restrictive path of monetary policy relative to the baseline path might be appropriate. In the current environment, the stakes are higher than they would be if inflation was at or below target. With robust growth, a solid labor market, supportive financial conditions, underlying inflation above 2%, and some measures of inflation expectations recently rising, the risk that inflation expectations could become unanchored is higher than it would be if the economy was operating with slack and if consumers and businesses had not recently experienced a period of high inflation. Implied in the FOMC's statement on long-run goals and monetary policy strategies is a balanced approach that takes into account the extent and timing of both employment shortfalls and deviations of inflation from target when the committee's maximum employment and price stability goals are in conflict. A balanced approach is feasible if long-term inflation expectations remain well anchored. Controlling inflation is less costly, and the scope for responding effectively to variations in output and employment is greater when inflation expectations are tightly anchored. In other words, anchored inflation expectations make a balanced approach feasible for addressing conflicting goals. In a scenario in which the FOMC's dual mandate objectives are seemingly in conflict, I would look closely for assurances that medium to long-term inflation expectations are remaining well anchored, and I would be especially concerned by evidence suggesting they are becoming unanchored. That is why I put a high priority on making sure inflation continues to converge to the FOMC's 2% target in the current environment of full employment and strong growth. To conclude, I expect inflation will return to 2% over time and the labor market will remain strong. At the same time, I perceive the risk that progress on inflation could stall as being greater than the risk of substantial labor market weakening. And while not my baseline, there are scenarios where the FOMC could face conflicting dual mandate goals. At present, however, the economy and monetary policy are in a good place. A patient approach will help us achieve the goals of maximum employment and price stability and support a durable economic expansion for the American people. Thank you. Do you want me here?
You're there.
Yeah, okay.
Good afternoon, everyone. I'm delighted to have this opportunity to speak with President Musalem. May I refer to you as Alberto?
Perfectly.
Excellent, thank you. You may call me Professor Cohen.
Okay, that's fine.
That was a wonderful summary of your thoughts on current monetary policy, but I'd like to start with a different subject. You're a newbie, you're a rookie when it comes to being a president of a Federal Reserve Bank. You've been at the Fed of St. Louis only since April. I know that you've had extensive experience in the Fed system, including here in New York. But if you could tell us a little bit more about the St. Louis Fed, what are the regional responsibilities? And I have a particular interest in hearing about the research that gets done at the St. Louis Fed. And don't forget to tell us about my beloved Fred. And I think that all of the economists in this room are big fans of Fred. So please tell us more about the St. Louis Fed.
Professor Cohen?
Yes.
Okay.
No, please.
So it's been a fantastic experience. I've been very well received and welcomed to the St. Louis Fed and to the district. It's really been a tremendously warm welcome. Something that you learn very quickly when you work at the Fed is that each reserve bank or the reserve banks have many responsibilities. We're known for monetary policy, but that's one of our responsibilities. There's banking supervision and regulation. There's promoting a safe, effective, and accessible payment system. There's engaging in community development and consumer protection. And there is, in the case of St. Louis and 4 other reserve banks in the system, serving as a fiscal agent to the U.S. Treasury. So, there are a lot of business lines that you have to quickly get up to speed on. And some of those I was up to speed on, some I wasn't, and I had to learn very, very quickly on the job. And the team was fantastic in producing all kinds of briefings and with a lot of patience walking me through all that I needed to learn. So that's it. In terms of that's the overview. In terms of Fred and economic research, we have a fantastic economic research team. Ranks high across policy institutions, ranks highly across academic institutions. And, think of two bookends. On one hand, there's raw data, which is disseminated to the world through Fred, which is the database that, for those who are economists in the room, I've been using that since I was in my 20s in this first iteration. And, today it is, a very popular and very useful tool for anyone who wants to understand the economy, the U.S. economy, and also the global economy. So that's at one end. And at the other end of the research that we do, it's, I would say cutting-edge academic research published in peer-reviewed journals and everything in between. So I'm very fortunate to have the good counsel of that team.
Yeah. Terrific. Thank you for that. And let's dig in a little bit more to your comments that you gave from the lectern regarding monetary policy. And I thought you were very clear in terms of the baseline expectation and also a plausible alternative. So let's talk about some of the things that you highlighted that you will be monitoring so carefully in terms of intermediate to long-term growth for the economy, specifically keeping inflation stable and at a somewhat lower level than it is right now. But if you could also tie that into what you'll be monitoring with regard to productivity growth in the United States. I always teach a lecture to my class about productivity is the single best metric, telling us about how a country will continue to provide wealth and prosperity to its people. So give us a sense of how inflation and productivity are intertwined and what you'll be looking at going forward.
Thank you, Abby. And I fully agree. When I was teaching, I used to tell my students, the reason we have financial markets and capital markets and the reason we have investment and growth is because of a promise of a brighter future, right? And a brighter future happens because of productivity. That's how we pay our debts. That's why people invest. That's why the world grows, because of this promise of a brighter future. So productivity is tremendously important. For us at the Fed and for the economy in general, productivity is really important because it determines if you want, the speed limit of the economy, right? So in an economy that's highly productive, the economy can grow at a faster rate in a way that's non-inflationary. So productivity helps with inflation and raises standards of living through, just higher GDP per capita. So it's probably the most important economic variable that is out there, followed very, very closely by inflation, right? Because inflation is a regressive tax. But we'll get to that in a minute. So, one of the big questions out there right now, particularly given that we're living in a world of very fast technological advancement, whether it's AI or non-AI, whether it's software or hardware, are we in a new productivity paradigm? And it's really hard to in real time, it's very hard to understand whether you're in a high productivity regime or in a low productivity regime. What we can say is productivity has been increasing in the last 2 years, and it's now approaching trend productivity. And the big question out there is it going to go above trend? Are we going to see something where the supply side of the economy gets much more effective, much more efficient? And this doesn't have to be AI. It could be labor-saving or labor-enhancing technology, not called AI, right? It's productivity can come from many technological advances that are not necessarily AI. AI is just one of them. So we're doing a lot of research on that. We're trying to understand that. That has implications for understanding what the long-term equilibrium interest rate is or may be. It has implications for understanding how to set monetary policy today and over time. So we're focused on that, as are many other people.
Is the United States measuring productivity properly, particularly as our economy has shifted in recent decades from manufacturing to much more service-based?
Abby, that's a great question. And there's that old question of, are we even measuring the national product accounts the right way, real versus nominal? So all data is imprecise. I start from that, no data is perfect. And there's certainly some potential measurement errors there. But I think now with the advent of much more complex and complete data sets at a microeconomic level, we can now try and measure productivity within firms. So forget the macro data. You can now look at within sectors, across sectors, you can understand productivity of specific firms within sectors. And there, that's a way of cross-validating or cross-checking whether the macro data is, is telling you a story that you can rely on.
And when you look at those micro data, are you seeing a disconnect between some of the macro information and what we're seeing at the company-specific level?
Actually not. We're seeing some coherence there. So we're seeing that, unsurprisingly, but verified that some of the sectors that you would imagine would be more productive are the ones that are more productive. So in the technology space, those technology firms are experiencing higher productivity growth than non-technology firms. Firms that have a high percentage of their workers that are, have high educational attainment levels tend to be more productive than those that do not. And so we spent a lot of time this year at the St. Louis Fed trying to figure this out. We were asking ourselves, does the macro data, exactly the question you asked, does the macro data tell us the right picture? And our very able economists said, let's look at the micro data and see if they gel. And the answer was that they do. So that was good.
Your prepared remarks made it very clear that a pattern of stable, consistent inflation at a level somewhat lower than where we are now would be consistent with intermediate to long-term economic growth. What are some of the risks out there that you'll be monitoring to get a sense as to whether there's something that will push inflation off that trajectory on a sustained basis?
Yeah, there are a lot of risks at present. Some of them are policy-related risks. So there are a lot of indices of policy uncertainty, and they're all pretty high right now. There are geopolitical risks out there. There are the risks of mismeasuring the economy, as occurred in previous decades, where long ago decades, but that can't be forgotten, where in real time there was mismeasurement in terms of what the output gap was in real time, how hot the economy really was in real time.
So you're referring to the 1990s, when we basically undermeasured GDP by a very significant amount.
That's an example. You can also go back to the late 60s, early 70s, it's one thing to look at history, and it's one thing to do things in real time, and there's always the possibility of mismeasurement in real time. So that's another risk that I try to be mindful of all the time.
Is there also the risk of not modeling things properly? We all look at models within the financial community and at the Fed that are based upon historical data. Are there some things that you're concerned about that we are not focused on sufficiently and not modeling properly as we think about the future?
So central banks, and the Fed is no exception, has outstanding modeling capabilities. Something I've learned the hard way throughout my career, in the Fed or outside the Fed, mostly outside the Fed, is that there's no single model that you can ever trust. You have to rely on a multitude of models, and then even after that, you have to put a lot of salt on those models, with a big pinch of salt, and then you have to use a lot of judgment of your team, not just your judgment. You have to bring a lot of diverse opinions into the room, different opinions that may be seeing the world in a different way and may make you think about how to reach a good decision. So I like to, I'm veering from your question, but I'd like to say that I don't rely on any single model, and I don't rely on any single person. I try to get as much information as possible, including, you know, going back to your first question, one of the very satisfying parts of this job is that you have to be out talking to, you know, business people, business leaders, community leaders, consumers, producers, all over your district and the country, you know, market contacts, and that informs the models also. So that's kind of how we try to solve for the problem of, are you missing a model, which was your question, I think.
Yep, absolutely. So if I can turn to another subject, and that has to do with some of the developments out of Washington most recently. On Tuesday of this week, there was an executive order signed in the White House that affects independent agencies, in which the White House is claiming that it can control regulatory decision-making. Now, there was a carve-out for the Fed on monetary policy, but not for what us old Federal Reserve employees used to call sup and reg, supervision and regulation. How would it work for someone in the White House to be determining the regulatory and supervisory activities for the Federal Reserve System?
So, Abby, thank you. We are, the reserve banks and the board are receiving the orders, reviewing the orders in real time, in addition to the details of those orders. In the past, the practice has been, over many administrations, that the Fed you know, seeks to align with the executive orders, and we're working on taking steps towards aligning with executive orders as appropriate and as consistent with applicable law. And you know, given that this just came out a day ago, we're still in that review process, so I can't say anything further.
Understood. And you have great expertise, having represented the Fed at the Bank for International Settlements when you were here at the New York Fed. And of course, the change in the regulatory posture could affect relationships within the regulatory agencies within the United States, but also outside the United States. So give us some thoughts, if you would, about what you think capital structure should look like in some of the banks. Do you think that from an international standpoint, the G-SIBs are properly structured right now? Do you think the balance sheets are in good shape?
So I don't want to get too far down this topic, but I'll say I believe the banking system is strong and well capitalized. I'm going to paraphrase something that Chair Powell said, I think a week ago. And he said he believed the same, that the banking system is strong and well capitalized, and of course, including the G-SIBs. And he did talk about the Basel III endgame, and he said that he felt that was a minimum standard that was useful so that foreign banks wouldn't be able to operate with lower capital levels and therefore with a competitive advantage over US banks. And I believe that was the intent of that process. What happens going forward, that will depend on, as Chair Powell said, on who the leaders of the FDIC, the OCC are, and how that conversation happens domestically and with international partners.
Yeah, and of course there have been discussions in Washington perhaps about combining the activities of different banking regulators. I would add, just from a historical perspective, there were similar conversations in the mid-1970s. So this has been sort of an ongoing situation. Let me turn our attention back to the US economy. There are obviously some very significant structural changes underway right now, and these include investment, as you mentioned, the impact on productivity, but there's also the potential for structural change in terms of growth in the labor force. So much of that growth, more than 50% over the past decade, has been related to immigration. What happens if we dampen down immigration? And of course, the issue is not just at the low end of the education spectrum, but also at the high end?
Thank you, Abby. So let's talk about some facts first. So immigration flows began to decrease in June of last year under the prior administration's executive order tightening the border. And ever since then, the immigration flows have been declining. Now they have been, we don't have data yet for this year too much, but they seem to continue that declining trend. When the immigration surge happened, remember what happened? Let's go back to COVID. During COVID, there was no immigration, right? People were locked up in their homes, in their countries, so the immigration went very low. And when the world emerged from COVID, there was a makeup. People that couldn't emigrate during COVID, there was a surge after COVID, and that was 22, 23, and 24. And now there's a ebbing of that flow. And I think so what happened then? What happened then is you had new people arriving, the population of the country increasing. You can think of those folks were additional workers, but they were also additional demanders of goods and services and housing, right? So there was more supply and more demand at the same time, and the net effect is a bigger economy. The impact on inflation is unclear, right? Some estimates suggest that it was neutral. Some estimates suggest that it was negative, meaning lower inflation. Some suggest that it was positive, particularly on housing. So I don't have a view on that. There are some sectors of the economy that rely heavily on immigration, so hospitality, agriculture, construction, and as those flows of immigration decline, it's possible that there may be some labor shortages in those sectors. In my own district, in the 8th District, when we talk to business leaders in the construction industry, they report already shortages of workers, have been reporting for 2 years now. This isn't new to immigration. So it's already a tight labor market in some of these sectors. So that could have some effect there.
Understood. What about the impact at the other end? We see a decline, for example, in H-1B visa applications.
Well, for anyone who's managed a business, you always want to recruit the best and the brightest. And the best and the brightest, many times or sometimes, come from abroad. And if going back to the point on productivity you made earlier, if you look at the folks that are running innovation in Silicon Valley, a lot of those folks, probably were immigrants at some point in time. So it's important, I think, for sustained productivity that the U.S. continue to attract the best and the brightest from the entire world. Just as the U.S. is attracting a lot of capital from the rest of the world to fund its growth, that's meaning dollars. It's important for the U.S. to continue to attract human capital from the rest of the world and make sure we continue to have a very productive, bright future.
Something that I know that you're quite expert at, but may not wish to discuss, but I'll ask the question anyway, has to do with the Fed's own balance sheet, adjustments to what's being held on it and so on. Is that something that you are at liberty to discuss with us? At least what has happened to this point?
Can you be more clear?
Sure. Basically, the Fed had various focal points of monetary policy, not just interest rates, but also stepping into the capital markets themselves.
So, we are in balance sheet runoff mode. There's been no decision to change that. The minutes released yesterday suggested that we have begun a conversation of understanding what the size and composition of the balance sheet ought to look like once we can understand that the financial system has transitioned from abundant reserves, meaning a lot of reserves, to ample reserves, meaning the amount of reserves required to allow the banking system to function and the financial system to function effectively with a little buffer, or with some buffer. So we feel that we're still in the abundant reserves scenario, and we are actively discussing and thinking about what that long-term size and composition of the balance sheet might be, but no decision's been made.
Okay, great. The minutes that were released yesterday actually spent a good deal of time on this matter. One of the comments that is out there in the financial markets has to do with whether the recommendations or suggestions made by some, not necessarily at the Fed, but elsewhere, that crypto should belong on balance sheets of banks. Some people are also talking about a crypto reserve for the nation. Any thoughts on that?
So I can't comment on the crypto reserve for the nation. I think that's a topic for the Treasury, the administration, the White House. It's not something that I would like to opine or speculate on. On banks engaging in business with firms that are in the digital asset business, that's already happening. Banks are doing so under the current regulatory regime. They're within that regime, they're measuring and managing the risks. They need to be aware of those risks. Whether banks should hold digital assets in their balance sheet directly rather than do business with customers, I think that's an evolving area of regulation and perspective.
Absolutely. I have one more question before we turn this over to the people in the room, and that is, what else do you worry about? Do you have a list of things that you're monitoring that you think may get on the radar screen, intermediate to long term?
So the one thing that, there are many things that worry me, but I sleep really well at night, but I do worry about things. Cyber risks is, this is probably not surprising to anyone. If you ask, CEOs, any CEO survey has cyber risks at the top of the list in terms of what could go wrong. And so that's something that I'm always thinking and I'm worried about. It could be a cyber risk that disables a big part of our economy's infrastructure, financial or non-financial part of the economy. And that's something that worries me. Yeah.
Okay.
And there are 20 other things, but I think I'll just stick to that one.
I share that concern with you.
Yeah.
I think we're ready for questions from people in the room. There's a microphone over there, and Mr. Dudley, please.
I'll go easy on you, Alberto. So my question is about what your early thoughts are about the Fed's monetary policy framework, how it did during the COVID pandemic and the aftermath. And as you reflect on how the framework did and how it was operationalized, what kind of changes do you think should be at least contemplated? What do you think sort of should be in scope?
Thanks, Bill.
Without saying this is what you're for.
Yeah. Thank you. Thanks for the question. I'll start with saying we're expecting, let me just provide some logistics here. We're expecting to be finalized with discussions of what the new framework will look like sometime in the late summer. There's a conference, open conference in May in Washington to discuss this openly. There will be also Fed Listens events around the country to get perspectives from community leaders, business leaders, gather a lot of information. Internally, every reserve bank, every president, every governor is beginning to think, how should it look? And I think a lesson, and I think this is in the minutes also, so I think a lesson that I learned was that is a lesson about robustness, right? When you set up a strategy or a framework, you would want it to be robust to different states of the world, different scenarios. And the previous framework, or the framework we currently have that is being revised, was put in place with a zero lower bound on nominal interest rates in mind, because we had been at the zero lower bound for almost more than a decade for sure. And there was a good reason why it was devised for that environment. And that's the ultimate asymmetry, right? You can't go below zero in nominal terms. So the framework had in it a lot of asymmetry built in to try and not allow yourself to be captured by the zero lower bound and stay there forever. Well, it turns out the near future can be more like the distant past. So tomorrow can be like 80 years ago. We had a pandemic that hadn't been around for 80 or I forget the number, 90 years of it, and the framework with these asymmetries turned out to be appropriate for the prior decade, but for the situation at hand, it wasn't well designed for that. So I'm thinking hard about robustness. What is a framework that can stand the test of time in different regimes? I'm also thinking about communications. How can we communicate better? There's always, modern central banking is a lot of it is about communicating and being, using communications as a tool. And I think communications have been fairly good, very good, but there's always room for improvement. I'm thinking how we could do that. And those are two generalities, but those are two things that are, two buckets that I'm thinking about.
Hi, thanks for all your comments already. I have a question about how you think about the economic impact of tariffs for policy. So I'm not asking if tariffs are good or bad, but let's just say that there are more tariffs in our future. When you look at the various models you look at or the people that you talk to, is that a cause for concern about inflation, or is that a cause for concern about growth, or how do you think about it?
So the standard thinking about tariffs is, you increase the price domestically because there's a tariff imposed. Some of that cost is absorbed by the foreign exporter. Some of it may be passed on to the domestic importer. That depends on the slope of the demand and supply curves, the elasticity, how much of that gets passed on or not. And the outcome is through income and substitution effects, you get basically a lower amount of consumption of that good. And at the same time, you get a substitution out of the foreign producer of that good to the domestic producer. So two things happen at the same time. So less quantity demanded, but more quantity demanded of the domestic version of the good. Let's call it beer, domestic beer as opposed to German beer or whatever. And a higher price. Now, if the tariffs happen one time, it's a one-off increase in the price level. It's not inflation. It's a one-off increase in the price level, which then goes away, right? It's a transitory inflation is what it would be, right? I'm hesitating to use that word for obvious reasons. But that's in the textbook, right? That's the textbook. In real life, tariffs can be can impact final goods. They can impact intermediate goods, in which case dynamics would be different and maybe longer lasting. They can be applied over months or years, not just one time. So it gets hard. The textbook is one thing. A $30 trillion economy is another thing, with trade relationships with counterparts. And the dynamics of that are going to be, I'm going to be trying to understand them in real time. And what I'm going to be interested in is parsing out, the first round effects of a tariff from potential second round effects of tariffs. And that's going to be a hard thing to do. But we have fantastic researchers, fantastic analysts at the Fed, and we're going to be working really hard on that to try and understand first round, second round.
Great. Questions over here? Okay, great. Thank you. Can you identify yourself, please?
Yeah, sure. I'm Tendai Kapidze. Probably the important part of my bio is that I'm a graduate of St. Louis University.
There we go.
I hope you've been to some games. So you mentioned, tariffs in your remarks. You spoke about a couple of scenarios. You mentioned increased uncertainty. About a year ago, Ben Bernanke gave some, guidance to the BOV that maybe they should give more formalized scenarios in their forecasting. Is that something that you think would be helpful in terms of communication, maybe related to the monetary policy framework from the first question? So what are your views on that? Would that be helpful in terms of communicating, more clearly or more helpfully the Fed's positions in terms of giving more formalized scenarios in the Fed communications?
Thank you. That's a great question, and not only because of your university, but it's a great question. So I think what I tried to do today in my remarks was to present scenarios, because you never know what scenario you're going to be in, and it's important to say, well, if I'm in scenario A, here's what I think I ought to do. If I'm in scenario B, here's what I think I ought to do, or in scenario C, and in communicating that to the public, you give a sense of, what's the reaction function, right? What does it look like? So I'm very much in favor of communicating with scenarios. What we do at the Fed, and Chair Powell has talked about this extensively, is there are many scenarios that the staff produces for the policymakers to understand, scenario A, B, C, D. I think we are up to like 6 or 7 scenarios at every FOMC meeting, and they're very well-structured scenarios. They're very thoughtfully designed scenarios. A lot of complexity in the world, but the staff reduces it to distinct scenarios that you can look at and begin to form a view of the world. And I think that is very valuable. The more you talk and analyze alternative scenarios and understand the actions, the more prepared you'll be if you start to understand whether you're going down path A or path B, right? I think that's a much better practice than trying to make policy or just think about the future, thinking only about the modal scenario or the point estimate, as it were. So I'm in favor, and I'm in favor of it, and I think I did it today.
Thank you so much. I'm based with Advance. I'm the Chief Investment Officer. It's a privately held enterprise in New York. My question is about AI and data. You mentioned a few times model. You have the, one model is not enough. You use a lot of model. And in today's environment, I think a lot of model, the Fed's different offices uses, a lot of financial entities probably have similar data, similar model as well. And so in many cases, everything the Fed are looking at, reviewing at, are interpreted by bigger audience. What actually drives the difference between Fed announcement and market expectation? We have seen quite a bit of, market price volatilities in the past year, particularly front end of curve. And if everyone is anticipating same amount of data, what drives that difference? Is it more of the mandate of the Fed that's much more stability versus market is much more probability? Maybe you can just help us to comment a little. If everyone's anticipating same data, why the market can arise such different and very volatile difference between with the Fed actually announced. And in the age of AI, how is Fed take that into any plan, anything that you think you're doing?
So thanks for the question. That's a deep, deep question about decision-making under uncertainty. So let me simplify it, or try to simplify it. If you put 2 people, the Fed and the public in this case, right, or 2 agents with the same information, they may still make different decisions because they have different preferences or different financial constraints. So I used to be a market participant, and there are a lot of there are different financial constraints, budget constraints, balance sheet constraints, leverage levels that different actors have. So even if they all had the same information, there are other factors beyond information that may lead you to have different expectations, make different decisions. And that's what makes markets, frankly, right? That's a good thing. So I'm not sure I can answer your question, but I think the Fed has its information set, the markets have their information set, the Fed tries to communicate about its information set with the markets interpret that communication, and sometimes there are different, different perspectives. Sometimes the markets think the Fed ought to be doing, this one thing. Somebody said, well, forget it. The markets think the Fed ought to be doing this one thing. The Fed doesn't quite think that yet, and so the market, goes in one direction, the Fed doesn't. There are times when it's the other way around. The market has gone in one direction, the Fed feels, well, we feel differently, and the Fed moves differently to the market. So I hope I'm answering your question. It's not just about what information people have. There are many other factors at play that lead to different decisions and different expectations.
And if I may add one more thing, as we are running out of time,
Okay.
one of those perspectives that may be different between market perspectives and the Fed is that of time. The Fed tends to have a longer time horizon that it's thinking about than do many in the markets, particularly some of the traders who are really driving a lot of the flows on a day-to-day basis.
I mean, that's a fantastic point. And in addition, those traders sometimes are highly levered. So they're very sensitive to any epsilon change in information. So, yeah.
Please.
Thank you. Everyone, wasn't that terrific? Thank you so much. And thank you for letting us host you for your first big speech, as they say. So thank you. We like that at the Economic Club of New York.